Irwin.
Yes, sir.
All right. Well, welcome.
Welcome. I feel welcome. Thank you.
Okay, so I may just hold this. Yeah, all right. Give me a sec here. I'm just going to grab the questions I have for you, Irwin.
You're getting a lot of interesting questions from the audience.
We will. Okay, I'm going to take a seat here.
I've been following along.
All right, so Irwin, I'm going to let you introduce yourself, but I'm going to do a quick introduction. Here? All right, I'm going to talk to you over here. I'm getting rearranged. So Irwin Stein is a securities attorney, and he's been a vocal critic of a lot of what's happening in this industry. And I'll call Irwin a contrarian. And I think it's really important to have Irwin's perspective heard in a discussion like this. And one of the things that I've heard, because I do a lot of conferences and events, is that this industry is very self-congratulating. People pat each other on the back. It's all roses. It's working, or if it's not working, it's going to work, or if there's a rotten deal, oh, you know what? Well, there's going to be better deals around the corner. Irwin is a prolific blogger, and I'm fascinated by what he writes about. In fact, he's been exceptionally critical of some of my own clients. So I'm taking a calculated risk because despite my interest in protecting my clients, I think Irwin has some really damn good points. And so we're honored to have him here. And Irwin, why don't you go ahead and introduce yourself and tell us about your background.
Thank you, Darren. I appreciate it. I don't think your clients need to be protected from me. I think they need to be protected from themselves sometimes. I started in the brokerage business in 1975 with an old school New York Stock Exchange firm, Payne, Weber, Jackson, and Curtis. They were somewhat insistent that I learn the business, so I spent some time in the margin department. I spent some time on the trading floors. I learned what the brokerage industry does. And I was registered as a stockbroker, as a supervisor. I was registered for commodities and options. I was there about 3 years. I went off to another firm, E.F. Hutton and Company. There I was a division attorney for a division that included their insurance company and their proprietary mutual funds. I went into private practice. I was writing public offerings, a lot of private placements. I represented a lot of small brokers in and around New York. 1984, I moved to San Francisco. I joined a law firm that represented public real estate trusts, a European venture capital company, broker-dealer, a lot of what you'd call securities law. 1987, I became general counsel of a real estate syndicator that had property in 23 states, $1.5 billion under management. We did public and private offerings there. 1990, I kind of backed away from practicing. I went to work as a teacher at Golden Gate University. I taught law and economics, finance for about 10 years. And I did some expert witness work. I did a lot of consulting with what were called tech startups at the time, but they were hardly technical by today's standards. In the last 20 years, I did a lot of consulting, a lot of litigation in securities, a lot of securities arbitrations. And I've seen a lot, I've read a lot. I've had the pleasure of meeting some of the larger players in the securities industry over the years, and I've been a student of it. I enjoy it. So I've had a lot of fun. It was a good career. I'm glad I kind of worked out the way it did.
Okay, so you're obviously a a credentialed person. You've got tremendous expertise, experience, insight, context. So I want to just cut to the chase. So I'm going to start with a loaded question. What is it about the crowdfunding industry or securities crowdfunding industry in particular that has you concerned?
Well, I first looked at what you now call crowdfunding back in the late 90s, when they referred to it as selling securities over the internet. I actually became involved with the Jobs Act in 2012, 2013. I spent a fair amount of time in the hospital getting chemotherapy. I had a lot of time on my hands. And the discussion in the securities industry was about Regulation D and the rule permitting general solicitation, because that had been a thorn in the side of the Reg D market since Reg D, which is like 1982. Since I started blogging about it, and I went to a lot of websites, blogs by other securities lawyers to learn about it. The more I blog about it, the more questions I ask about it, the more I run into people like yourself. So my interest is, I look at it as just securities law and securities issuance. To me, it's not mainstream, but it's corporate finance.
And so what are you seeing in the market? You know, you've written a couple blogs in particular over the last few months about portals, certain issuers. What are the things that are happening in this industry that seem to be a red flag to you?
Well, it's not just me, okay? The regulators, the SEC, the FINRA, are all raising red flags. 6 weeks ago, one of the SEC commissioners at a program not unlike this suggested that the companies being offered were so bad it was a race to the bottom. And that can't be good for the industry. It can't be good for the investors. And there's got to be a symbiosis there. And so I don't see this as really that complicated.
So let's talk a little bit about the portals. Are the portals, from your perspective, registered and non-registered alike, are they adequately diligencing the companies doing Reg CF, Reg A campaigns or not?
Well, some are and some aren't. Okay, there are portals and platforms that have good people running them, people in many cases who came out of the brokerage industry, who understand the brokerage industry. You have to look at this as if you're selling securities, because that's what you're doing. And there's a mainstream marketplace that does that, does it very well, does it efficiently, and it could teach this industry a lot. Because a lot of what's happening is you're reinventing the wheel that doesn't need to be reinvented.
So should there be some minimum standard the portal should have when deciding or evaluating whether or not to list an issuer? Or should it be as simple as, if an issuer hires an attorney, files a Form 1A with the SEC and is qualified, can't that be a method, or no?
Well, I think it's somewhat subjective. In the mainstream marketplace, the investment bankers are at the top of the food chain. They're the ones who work with the issuer, vet the issuer, structure the offering, price the offering, and that's what's missing to a very large extent in the crowdfunding market. Would I take a check from somebody who wants to do a Reg A Plus that I know in my heart they're never going to sell? No, I won't do that. I don't need the money that bad.
And you've talked about criteria for issuers. What do you think the criteria should be for issuers to demonstrate they have real potential for success? You've been critical of deals like Elio Motors, it's public record. From your perspective, given your experience, what are the criteria?
Well, I think revenue is a good place to start. I think a company should be able to demonstrate to investors that it has a product, can source the product, and that people will pay for the product. And that, when you have less than that, it's going to be that much more difficult to get investors interested.
Well, let me interrupt you.
I think it's also important. I'm sorry, go ahead.
So, well, would that apply to Snapchat or Twitter or Facebook? A lot of these billion-dollar unicorns, they defer generating revenue, and they prefer to focus on rapid growth and then deal with making money later. So, what about the investors who are interested in trying to get into a company like Social Blue Book, who we just heard about from Sam? Are you suggesting that tech companies aren't good fits?
I think there's a difference between revenues and profits. The thing that companies like Facebook had revenue, and that's fine. They demonstrated that they had something that people would buy. A company that's just a concept or a minimum prototype is just that. It's a minimum.
But don't a lot of, isn't that how any business starts? You start with nothing and you develop something. All of those companies at one point, at inception, have to raise capital somehow.
Well, there are lots of ways to raise capital without going to the public. Okay, there are a lot of sophisticated investors that'll write a check to a business that looks good.
And so what are
I think where the industry fails is that it refuses to acknowledge that there are some companies that just aren't going to make it and aren't worthy of investment. And yet the industry wants to say, well, these entrepreneurs entitled to an opportunity. If your Uncle Fred won't give you an investment, why should my Uncle Fred?
That's a great point. So let's look ahead 12 months. And so from your perspective, you're seeing a lot of issuers that are going to market that, from your standpoint, aren't qualified. Revenue, pre-product. What do you think is going to happen in the next year? What do you predict?
Well, overall, I think in the next year, 18 months, that despite the time and the effort and the money that's gone into building this industry, there are going to be a couple of pretty good-sized scandals that are going to tell prospective investors that this isn't safe.
So you think, when you say scandal, are you talking about a business failing to execute on a business plan? Are you talking about issuers that are consciously defrauding people?
Oh, no, I'm only talking about the latter. Okay, the reason, and I didn't bring it up, you did, and a number of people talk about Elio. They were taking deposits from people for a vehicle that didn't exist. Okay, and I know that in Louisiana, people are investigating that. Government agencies are investigating it. I got a call from a television station in Louisiana who read my file. It's going to blow up.
Okay, so you think it's going to blow up. So, because I think you're such a fascinating guy, I don't want to hog the conversation. I want to open it up because we have people here that may have questions. So I want to cut to the chase with the audience. Who has a question for Irwin? Hugh.
How you doing, Aaron? How you doing?
We got to turn that mic on.
Yeah.
He's coming. Go ahead.
Sure. Good. Irwin, pleasure to meet you. And I think you bring some fascinating balance to the space. But in fairness to Darren, one of his first questions were, I believe Darren was saying is that, do you think that there should be some underwriter's lab or some ISO, some kind of standard within this space to kind of protect the investors? Where you can't just take anything, like you're saying, anything that sounds good in a concept, and we're just going to find an issuer who will say, let's go public with it. Do you think there should be some standards? Of course, revenue is always a great pathway, but do you think that there should be some kind of maybe body or some kind of organization that doesn't take the spirit of the entrepreneurship, but doesn't allow just anything to get public? Because that's going to burn the investors, which I do think would burn the concept down.
I think an objective standard is going to be too restrictive or not restrictive enough. I think that the platform or the portal has to exercise its judgment on a case-by-case basis, just the way the mainstream industry does.
Any other questions?
Yeah, I have
Gene.
something. Irwin, this is Gene. We've been talking all day. Here's my question. Crowdfunding's nothing new. It started in 1606 with the Dutch East India Company, selling your stock to a little bit of stock to a lot of people. Okay? And so really the only thing that's changed between 1606 and today is that instead of a broker calling you up and swearing that you're going to be making a good investment, you're able to see everything on the internet. You're able to evaluate something probably even better than the lying broker would have told you, because you can see it on the internet. You can see all the facts and figures and everything that's been regulated by the SEC. So what is your big problem with that, the fact that it's just on the internet?
I don't have a problem with things on the internet at all. I think that ultimately, I mean, the real estate industry has caught on that they can do this with great success. I think the idea that the average mom and pop investor can evaluate an offering is fallacious. I don't think that's ever been the case. I think that that if everything was on the internet, if all the disclosures were being made all the time, there'd be a lot less of a problem. But I can go today and look at offering and type in the principal's name into a search engine and find out all kinds of things, employment history and such, that's not in the offer. And it happens over and over and over again.
One more question?
So
Blaine?
there
this
are
is
good lawyers doing this and there are not good lawyers doing it.
So this is Blaine McLaughlin from the Folio Broker Dealer, and I'm giving that intro on purpose for this particular question, which is I'm sitting with Gene yesterday, and we're trying to talk about who are the investors that either want to or should invest in various types of offerings. And we oversimplified it a little bit and said there are investors with a capital I who might put in more than a few $100 into something with the intent of getting money back, and they might be under, using reg speak, a Reg D, 506B, 506C, maybe a Reg A, maybe an S1, maybe an S11. And then there are hobbyists. There are people who are having fun, who are dropping 50 or $100 on something because they think it's cool with no expectation of financial return. And they seem to be more in what we'd call the Reg CF category. And I'd love your thoughts on that differentiation, if there's such a thing. Not necessarily any value judgment on
I
either.
don't think you can have an industry that's really a segment of corporate finance and focus it on hobbyists. Investors have a particular orientation and expectations. One of the things that I find fascinating is that a lot of people who are selling securities have never really got a lot of experience dealing with investors and knowing what they want. The company wants money, investors want a profit. That's efficient. And ultimately, markets move toward efficiency.
Excellent. So we're going to wrap it up. I'm just going to ask one final question, Irwin, and thanks again for Skyping in for this summit. What are the top 3 things you would hope to see for this industry to mitigate risk for investors and ultimately grow?
Well, I think that, again, I think the industry is going to move and become more efficient. I think, like the mainstream industry, almost every company that does an offering gets funded. And most investors are happy with the investment that they make, even if they lose money. There is a lack of respect in the industry for the process and for the investors that needs to change. The focus needs to come away from, oh, what can we do from these entrepreneurs, to what can we do for these investors? And if they're your customer, if that's what you're selling to, then I'm not saying anything more or less than cater to your customer, and that covers every business that there is.
Excellent. Well, Irwin, thank you so much. Let's give him a round of applause for Skyping in.
Thank you.
Thank you, Irwin. Appreciate it very much.